Assalamualaikum warahmatullahi wabarakatuh. My name is Dina Taskia Salsabila NPM 244111034. I come from Management Class 24B. Here I will explain the accounting equation formula. The basic accounting equation, also known as the financial equation, is the basis of the accounting system. Quoted from the book Introduction to Basic Accounting, the basic accounting equation is an equation that generally describes the financial relationships that occur within a company. This relationship includes wealth owned from economic resources obtained from debt, obligations, and capital. The basic equality principle of accounting states that a company's assets must be proportional to the amount of debt, liabilities, and company capital. This equation is used to explain logically that every transaction that occurs will always affect the assets, liabilities, and equity of the company. The main function of the basic accounting equation is to maintain the financial balance of a company so that changes in the elements or financial position of the company can be identified. Thus, the basic accounting equation shows a balance between the company's total assets and its liabilities and business capital. The concept of the basic accounting equation can be seen in the following mathematical model. Assets equals liabilities plus capital. Liabilities equals assets, capital. Capital equals assets, liabilities. Elements of the basic accounting equation. 1. Assets are assets owned by a company. All economic resources owned by a company are counted as assets. 2. Obligations or debts, also known as liabilities, are a financial burden that must be met by the company. 3. Capital or equity is the net wealth that is the right of the company owner. Equity is part of the company's assets owned by shareholders or third parties. Example of basic accounting equation: Mrs. Linda deposited cash as initial capital for her business, namely Linda Taylor, amounting to IDR 8 million. Then, for additional capital, Mrs. Linda borrowed IDR 10 million from the bank. Then, Mrs. Linda bought a new sewing machine for IDR 14,800,000. So the basic accounting equation is as follows: assets equals liabilities plus capital. IDR 8 million equals liabilities plus IDR 8 million. The effect of the first transaction is an increase in company assets in the form of cash by IDR 8 million and also in capital by the same amount. Assets equals liabilities plus capital. IDR 18 million equals IDR 10 million plus IDR 8 million. In the second transaction there is an additional asset of Rp 10 million from bank debt or business liabilities. Assets equals liabilities plus capital. Cash plus sewing machine equals bank debt plus Linda's capital. IDR 3,200,000 plus IDR 14,800,000 equals IDR 10 million plus IDR 8 million. The third transaction causes assets on one side to increase in the form of a sewing machine of IDR 14,800,000.00 and assets on the other side, namely cash, to decrease by IDR 14,800,000.00. Changes in asset composition do not change the amount of liabilities plus capital, which in this case remains IDR 18 million.00. Thank you for your attention. Wassalamu alaikum warahmatullahi wabarakatuh.